These are 5-second charts. And this is what I mean by a smash and grab trade. The idea of a trade here is you see the markets jump. Now, you can't react fast enough to get onto that initial jump, and you'll see that when I share the ladders. So you can't get onto the initial jump, but if you assimilate the information quickly, you can sell because you can see that this is a huge opportunity. You can see that the markets have jumped. The good thing about that jump as well is it defines your stop for you. So if everyone, because often I get a question, oh, well, where do you put your stop? Well, once it jumps, the initial moves create these highs. So once you've got a high created, you can sell 5 or 6 seconds after the data. You know where your stop is. Your target is a minimum of going back through the origin of the move. Defining scalping, then that's where we are going to start, because what you often get when people talk about scalping is you get a lot of generalizations. And this was my first point of going, well, what do people really mean? And what are people really looking for when they're looking to try and understand scalping? Because a lot of times you get things like, oh, they're just short duration trades. Well, that's a bit vague. What's short duration? Because short duration to me is under a minute. Short duration to a lot of people, maybe half an hour. So that doesn't really explain it. Small winners. Again, small winners relative to what? Relative to a big winner. And what's a big winner? So yeah, when you were saying a small winner, are you looking at trades that go for 1-2 ticks? Is that the typical what people assume scalping to be? Minimal risk trades. This is the one that I despise the most. When anybody comes into trading and says, I want to take trades with very low risk. Well, the easiest way to take low risk trades is to just not trade. There is always risk inherent in trading. That is part of trading. You don't get paid something without taking a risk. So the minimal risk trades don't really stack up. Yeah, I get the idea that you're not taking on a large dollar risk on a lot of these scalp trades, generally because of the way that scalp trade structures, in that there is quite a well and clearly defined risk over the short term. A high volume of trades is one of the things I often hear as a generalization of scalping. This I completely agree with. But what is key to a high volume of trades is pockets of trade. Good scalpers are not sitting there all day long, click, 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 constantly. That doesn't work anymore as a business. You'll just rack up costs and ultimately you won't find enough edge in doing that. The high volume of trade comes when you recognize a phase of the market where you say, yes, that's the time. Now's the moment where I can scalp because this fits into my skill set. This is happening right where I need it to be happening. So let's go and have a little look at some of the things I'll go and cover today. This is just to list a few. And there are tons and tons of different ways that you can scalp. 1 point scalps in the S&P, yes, that is a viable strategy. That for me would fall very much into what I would call trick trades and potentially small flow trades. But even small flow trades, I would suggest, will generally look for more than 1 point in the S&P. So I would lean those towards suggesting that they're what I call trick trades. We probably won't cover too many tricks today, but I will show you a couple of little examples of this type of thing. There are also, and again, scalping is not just purely a ladder thing, specific pattern trades. These can be scalps, very, very sort of well-defined patterns that happen at very specific times of the day or very specific, phases of a move. You can trade those. We'll first go and have a look at what I would call a smash and grab trade. This is recognizing that a market has gone too far in one direction, has mispriced some information, has reacted too much to a comment. Any of those things are what I would call a smash and grab trade. A perfect example of this one was earlier on. It basically was the announcement that Trump will be introducing or holding a news conference on reciprocal tariffs at 1 o'clock. Now, as soon as the markets heard tariff, they started to drop, and you got this really quick whip down in S&P, in the euro, in lots of different markets. They all whip down. This is your smash and grab trade, because this is an example of where a market has moved on, well, non-information. Holding a press conference doesn't tell you anything more about the tariffs that we already know Trump is likely to get at some point introduce. So you're not gaining any more information. That's where you get market whips down, smash buy, and grab your winner on the way back. So for me, what scalping is, if I'm going to generalize and try and describe it in that way, for me, scalping is specific things, specific trades that apply in certain circumstances, in certain situations. That's what I'm looking for. We'll go and have a little look at a couple of examples of this now. And what we're going to go and start off with is that smash and grab trade. So how do you do it? What are you looking for? This is a short duration in and out scalp. You're not looking for more than what the market offers you. And that's another key thing with scalping. It's not getting into a trade and then thinking, but this might turn into a bigger and bigger move. The key to scalping is taking what's on the table, take what's in front of you, take it, be gone, and get out of there. That's the key to some good scalping. So short duration in and out. And this is one based on a market mispricing. Now, if any of you saw the non-farm payrolls data, you will have seen that almost all markets jumped up and then down. And if you look at a 1 minute chart, you'll see a candle with a huge wick on it to the upside, and then most of them all red. What happened there is this is effectively a market mispricing, or a mispricing of the sequence of information. So what we ended up with, and what happens with non-farm payrolls data, is to start off with, you get the headline number. This is the main number that everyone's looking at. And this came lower. Now, a lower number is bullish for, in this instance here, bonds, euro, treasuries, even the S&P. Reason it's bullish? More rate cuts. Now, we're not going to have to go into too much of the theory. This is something that we could cover on another session and do a whole session about macros. But the idea, lower number, it's bullish because it suggests the Fed's going to cut rates. But, and this was the big but, the quicker you recognize the rest of the information, average hourly earnings were higher, noticeably. Unemployment was lower. So your inflation component is going up. Unemployment is falling. All of this suggests you don't need a rate cut because inflation isn't coming down and unemployment's doing all right. You don't need a rate cut. Therefore, market turns back and we get these very quick drops. Now you're looking at those charts and thinking, okay, you got some time on that. These are 5-second charts. And this is what I mean by a smash and grab trade. The idea of a trade here is you see the markets jump. Now, you can't react fast enough to get onto that initial jump, and you'll see that when I share the ladders. So you can't get onto the initial jump. But if you assimilate the information quickly, you can sell because you can see that this is a huge opportunity. You can see that the markets have jumped. The good thing about that jump as well is it defines your stop for you. So if everyone, because often I get a question, oh, well, where would you put your stop? Well, once it jumps, the initial moves create these highs. So once you've got a high created, you can sell 5 or 6 seconds after the data. You know where your stop is. Your target is a minimum of going back through the origin of the move. Now, that might seem quite sort of technically complex, but it's a straightforward scalp trade. Market goes up, it's gone too far, you sell it, you know where your target is, you're in, it goes through that opening point, whichever market you take on. Once it goes through that opening point, then your job is just to exit, and you're looking to exit as the market slows down in these little areas here. This is a trade that can last you under a minute. So let's go and have a little look at. Right, when I start off, this is just before the data. So data is just about to come out. So this is why the markets are very, very thin. What you've got on the screen there as well, on the left-hand side, you've got the euro, then the 10-year treasury, then the 2-year treasury, and then the S&P. These are the 4 go-to markets for most traders on payrolls data at the moment. Right, so let's go and look at what happens. Remember, the data is going to hit almost immediately. So you will see all of these markets jump up the screen. That's the first thing you're going to see. I will play it through. I've got a few annotations that will explain what's going on, but it happens very, very quick. Right. So here we go. Market's nice and stable. They jump on the data. So you've now read in the data. You've had a chance to realize that actually this data is lower, or should suggest that the markets should go lower. Now the S&P has come off the fastest here. The euro is still pretty close on the highs. So what we've done, we've had this jump up. Euro is still near the high. S&P has already come back. Now the S&P had jumped up. If I take this back just a little bit, the S&P's jumped up to around about 12.13 area, the euro around about 27. So once you've seen these initial highs, you know where your stops are. So your stops are just above the high. So you may be looking at 10 ticks in the euro. If you can get in on the S&P around 12, you're looking at maybe 3 points on the S&P. That's all you're looking for on a stop. And you're playing this all the way back through the origin of the move. So there you go. S&P's now come off down towards double O. The euro then starts to come off as well. So this is all within a matter of 10 seconds, 15 seconds that you've been in on this trade. Markets are now starting to come off. The euro is now approaching its low. The S&P whips down through the low. So this is your first chance to exit some of the position. When the S&P whips through the low, you're out of that trade. The euro is now sitting at the low as well. This is now the time to start to exit the euro. So you managed to take about 20 points out the S&P. The euro looking at the moment about 40 ticks on side at this point in time. And what you're looking for now, the exit of the S&P came because of the acceleration down. So that's a specific thing. Again, scalping's about specifics. The acceleration was the specific to get out of the S&P. With the euro, you're looking for the kind of energy to fall out of it. That's what we're looking for here. So the euro, the energy starting to die down. It's slowing down. The S&P's bounced off the low. That's important information. The treasury's also just sitting around the lows. And as they start to bounce, the euro starts to bounce. This is where you want to try and get out of the trade. And that's your job done. That trade lasted about a minute and a bit to extract that out. And you got about 20 points out of the S&P and you got around about 40 to 45 points out of the euro. So that's the first trade. That's your smash and grab trade. Be specific, be quick on your entry. But what's really important with that, because what a lot of people make a mistake with on a trade like that, is they get in, they get on side, and then they start thinking, this might turn into a much, much, much bigger move. That's not what you're looking for. This is a specific trade. Get in, get out.